Hi, it's Lee and welcome to the Tesla Economist. I'd like to go into further detail as to how big a deal Tesla's operating leverage is, as it's not appreciated nearly enough. I'm going to explain how big a deal it actually is and what it means to Tesla. At the end of the day, net profits are far more important than gross profits or gross margins. Yes, Tesla has outstanding gross margins and they look great on paper, but before they're brought down to net profits, there's a big hurdle first, known as operating expenses, or OPEX. How much does it cost to keep the lights on? But through economies of scale, as a business grows and the gross profits increase, then the OPEX becomes relatively smaller. In other words, the operating margin is increasing. Tesla is still a small company, at least relative to the number of units they produce when compared to some of the legacy autos. Tesla still has tons of demand just for the two models they sell now, and a lot more demand when they start releasing more models. Tesla are working on ways of expanding with more cell and battery production and looking at new sites for more car factories. In other words, Tesla are still planning on expanding and growing relentlessly and will inevitably hit more economies of scale. I mean, Tesla won't even hit 1.5 million cars this year, yet Toyota was hitting around 10 million. So firstly, understand that net profit margin is the important one, as that's the profits that the value of the company is based. And if we remove tax out of that, then we're pretty much talking about operating margin anyway. So to be clear again, the more Tesla grows, the OPEX will become relatively lower and a smaller cost relative to revenue or gross profit. I'm actually going to start this with a hypothesis. I think that even if Tesla lost as much as 5% of their gross margin, as in they go from around 30% gross margin to having to drop the prices to only get 25% gross margin for autos, that their operating margin will remain the same if they can double the production number. Tesla gets too much praise about their gross margins and not enough about their operating margins. So let's see what happens. Well, we're just going to need to plug some numbers in. But what numbers should we use? We don't really have an accurate depiction of how successful Tesla are at the moment due to the past 2 quarters skewing numbers so much. Therefore, I'm going to go back all the way to Q1, before the new factories started hurting margins. I hope you don't think I'm trying to cherry pick a particular quarter here. I think we can all agree that these new factories were seriously hurting margins, along with the lockdowns we experienced. We're dealing with an automotive gross margin here of 32.9% in Q1. However, I don't want to make this too easy for myself, as there was a particularly high regulatory credit that quarter. So we'll do this task without regulatory credits, which comes to 30%. And this had an operating margin of 19.2% for the same quarter, which actually comes down to 15.6% without regulatory credits. So to be clear again, now we have some numbers. The theory is that if Tesla drop their gross margins from 30% to 25%, then if they have managed to double production, that the operating margin should remain at 15.6% if they double deliveries. Deliveries for that quarter was 310,000. Therefore, we're going to be working with a quarter that has delivered 620,000 vehicles. All right, let's start with ASPs. We have an ASP of 52,000 for this Q1, excluding regulatory credits. If this was 30% gross margin, we need to now calculate what the new ASP would be at 25% gross margin. The cost of goods sold per vehicle was about 36,500. So if we add a 25% gross margin onto that, then we have a new ASP of $48,700. Okay, so despite a 5% drop in margin, this is closer to a 7% drop in actual price. So we're dealing with Tesla dropping their prices by 7% across the board on average. Of course, in this scenario, we'd be assuming that Tesla has made no improvements on their cost and have not reaped any benefits of their costs lowering in a deflationary environment, both of which we would likely expect in such a scenario. We are solely focusing on the economies of scale of ramping up production. Oh, not only that, but also these prices are Q1 prices which don't include much of the price upgrades in the first place. So we're talking about 7% price drop before Tesla raised prices by something like 10% across the board. However, they also don't include the dollar strengthening either. But we can go into those details later. But I guess we're probably talking about a Model 3 costing around $36,000 in the US. In other words, I think we could safely say we are at a price point where there will be enough demand for 600,000 vehicles in a quarter. Actually, this was a lot more simple than I was thinking. I was thinking I'd have to go and calculate the margins of the new factories and work out the potential production rate there for some reason. But we have all our numbers. That was it. Now we can just do the necessary math. Well, aside from another tweak, I know Tesla's OPEX is insanely low and seems to always stay that way. Actually, it happens to have reduced about 5% in Q3 from this Q1 number. I believe mainly due to moving their headquarters out of Palo Alto and into Texas. But let's just raise the OPEX 20% still, as the company would have grown possibly to get to this next level. So we'll be using OPEX of $2.2 billion for this quarter. And then we know everything else. When we plug in all the numbers and do the math, we get all our answers. Now, although we have twice as many deliveries due to lowering the prices, we're now hitting just 86% more revenue, even though twice as many sales. So that's still a good increase in revenue, but obviously the lower prices are affecting revenue growth. On top of that, we're now getting a lower margin on these lower prices, so we get a lower percentage of margin on a lower revenue figure, meaning that despite twice as many deliveries, gross profit is only up 58%. Ouch. These price drops have really hurt gross margin. I'm not going to lie, that doesn't feel good if we're selling twice as many cars and only making 58% more gross profit. But let's continue on with our theory. Then we add the other sides of the business, and they don't alter things too much. Then we increase the OPEX by 20%, and we get an operating profit of $5.2 billion, up 84% from Q1 that was only $2.8 billion. Wow, now that's pretty good. Almost double the profit, despite a 7% reduction in ASP and a 5% reduction in gross margin. That's not too far off double profits. Despite those reductions, that is clearly a great sign of Tesla's economies of scale still to come. And then onto the answer we wanted, operating margin of now 16.3% compared to 15.7%. The operating margin is actually 4% higher than before. Tesla reduced their prices and reduced their margin, yet the operating margin actually increased. Of course, in reality, it really is the profits we want to be higher rather than the margin, but they were still up almost as high, except for one thing. I included the old energy and services side of the business. Well, back then, they made a loss. And now, they're profitable. On top of that, we're not likely to hit a run rate of 600,000 units in a quarter until perhaps Q2 2023, which is perhaps about 5 months' time, when Tesla are ramping up their energy side of the business finally. So perhaps we should make some tweaks there too. If I had a run rate of more like 3 gigawatt hours a quarter in energy and increased services to how it has been growing steadily, then the numbers change. We end up with a 101% increase in operating profit and a 17% operating margin. Although this looks really good, I think the biggest anomaly here is the fact that I used the old pricing. Tesla have increased their prices significantly since this Q1. The equivalent ASPs in just Q2 accounted for an ASP 7% higher. So in reality, this model is almost as if Tesla lowered their prices by about 14%, not 7%. Then why are Tesla margins so low the last 2 quarters? Well, I keep telling you, there was the lockdown and these new factories are still killing margins. This will not be going on forever. I think this essentially means that there is a bigger buffer in margins than people actually realize. And when these new factories actually start generating the highest margins out of all the factories, I think people will be quite surprised as to how profitable Tesla will become. And I didn't even say a word about subsidies or tax credits. But remember, this is only demonstrating Tesla's economies of scale. They still need to find ways to increase production. But if they can, then I see this company doing very well. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.